The statement of cash flows expresses a company's ability or inability to pay expenses with cash coming in during a period of time. It's all about the timing of inflows and outflows of cash. Sales don't always lead to immediate cash, but expenses may need to be paid immediately. This is a common cause of business failure or poor performance. It shows the actual cash movements for the business, typically on a monthly basis. The categories are a combination of income statement items and balance sheet items. It will also include sales revenue, expenses from the income statement, reductions in liabilities, increases in assets from the balance sheet, cash contributions from owners, or distributions to owners. There is usually a separate section of the statement for cash from operations and from financing activities. Cash from operations shows whether or not the business maintained a positive cash flow from sales and expenses. This is the most important thing to note because it's the reason the business exists. If it's not generating positive cash flow, that can soon lead to financial problems. The cash from financing activities can cover negative operating cash flow for short periods of time, but not indefinitely. We also consider the cash conversion cycle. This reflects the days from the moment you use cash, such as to purchase inventory or equipment, to when you collect cash. For example, how long will it take for the new forklift in the warehouse to actually make you money? If your business has a long cash conversion cycle, it may require short-term loans to fund purchases while you wait for payment from customers. Businesses watch accounts payable, a balance sheet item, closely. Good maintenance of accounts payable minimizes interest paid to suppliers. It also helps with maximizing the time you hold on to cash. Reducing the length of the cash conversion cycle adds value to your business. It's done in two ways. You can extend the time to pay for inputs with a close eye on interest, or you could decrease the time to collect cash from sales with a close eye on sales numbers. Both can be accomplished by digging into the cash flow. Excess cash flow can be invested in assets that will provide revenue. Falling short on cash might increase interest expense from short-term borrowing. You'll want to understand your role in the cash flow of the business.